Hey, this is Mike with the Generate FX Outlook for the week of 5/7/2012. It's first part of May, and here we are looking at FX once again. Last week, what happened? The US dollar, Japanese yen lower. That's an unwind of the carry trade. Something very interesting is happening over there with the carry trade, and that is going to push the US dollar, Japanese yen even lower over the next couple of weeks here. The Eurozone, the socialists win in both Greece and France. I think this means Euro down. It meant it last week too. The Australian dollar, US dollar broke down last week. The pound, US dollar, well, we had a short cover rally and then it fizzled late in the week last week and the pound fell off. Interesting development last week. And the Canadian fell as oil fell. I'm going to talk a lot about that in on the Canadian dollar side of it. So what do we have coming up for this next week here? A lot of good things. This Australian dollar, US dollar breakdown will continue. We're seeing the beginning of the unwind of the carry trade and the commodity trade I've been looking at for the last couple of years. The pound US dollar is going to be unexpectedly strong. Part of the reason for that is going to be the austerity in Europe. The austerity in the UK versus what's going to happen over in Europe. So US dollar, Japanese yen, I expected to see some sideways action there. And for the Euro US dollar, more downward pressure as the ramifications of the socialist win in Greece and France come to fruition. Also, I see a possible rally in the US dollar CAD. That means the CAD, Canadian dollar, will get weaker, but even if it does get weaker, I do see this being very choppy. Oh, and this commodities breakdown here too is something that I'm going to talk a little bit about as we're talking about the Australian dollar and the Canadian dollar. And I think there might be a breakdown happening in commodities right now. I've been looking at this trade for such a long time, and it's never happened yet. But we have such a supply of oil and copper and all these major industrial commodities out there in the world, and there seem to be a breakdown in how much people are willing to hold them. Late last week in both copper and in the oil markets, we had a breakdown, so that could be very interesting for the rest of the world too. So as we go forward here, this theme about commodities breakdown beginning, I'm going to explain it somewhat this week, but this is a long time theme of mine. The commodities markets, we've seen a gigantic rally over the last several years. We've seen gold, we've seen oil, we've seen copper really skyrocket in price. However, when I look at the actual supply and demand concerns that are out there in the world, I don't see anything that justifies such a big run-up in the price of these commodities, particularly in the copper market and particularly in the oil market. These two markets don't seem to have the demand out there that would require or justify these high prices. Not saying it's entirely unjustified, but still the price levels that they're at right now, I see them as being overpriced. So if this commodity breakdown is beginning, we could have a big move in a lot of different markets here, and we're hoping to be on top of that over the next couple of weeks. So in the Euro US dollar, one thing we know for sure, let's talk about that. All the solutions for the Eurozone cause a weaker Euro US dollar currency pair. Every solution out there causes it. What do we have? If we have a bailout of Spain, more bailouts of Greece, a bailout of Portugal, Ireland, this means a lower Euro US dollar. If there's write-downs of the credit, write-downs of the debt, that thus also means a lower Euro US dollar. If there's a breakup, I think that does mean a lower Euro US dollar too, as German export markets just get crushed as this breakup happens. It's a bad time for everybody. Germany will get smashed, and that's going to mean a lower Euro US dollar as well. And then two, with the socialists coming to power in both Spain and Greece, and probably across some of the other countries too, we're going to see some additional socialists come either have more power or actually take power, or they're going to see more spending, and that means a lower Euro US dollar. So something just to keep in mind is that these solutions cause a weaker Euro US dollar, every single one of them. So the fact that we have the socialists in France and Greece coming into power, they're going to spend and write down debts. That's what they're going to do. This is probably a good thing for the Eurozone. I can see this additional spending and these writing down of the debts freeing up a bunch of the frozen kind of economic potential that's over in Europe right now. But does that mean it's going to be strong for the euro US dollar? No. This spending and this write-downs, they will mean a weaker euro US dollar. And so that's what we're looking at right now. Now, if you take a look here at this chart, you remember this from last week. I was looking at this chart last week and I said this is a possible head and shoulders, and I was pointing here as a possible area where we might see some short covering rally, maybe not. But then why did I say it's a possible head and shoulders here? Because if you just take a look at this here, it's pretty simple to see that we went down there from that point. This is the current chart right now. Wednesday, Thursday, Friday of last week, we went down pretty hard in the euro US dollar, and it's been a decent move. Now, if you take a look here at how it really looks here, you can see, well, we had this head and shoulders, and we broke the neckline actually on this head and shoulders. You can see all the different. This is actually a double head and shoulders in the short term. And the target on this head and shoulders is 124.86. Now, we haven't actually closed below the neckline right here, but I do think it's been broken. Certainly with the socialists winning in both Spain, in France and in Greece, I suspect people are not going to wait much longer to try to get out of some of their euro positions. Now, this won't be a panic sell-off here, definitely not. This is going to be a more sustained move, and I want to show you a little bit why I think this is going to be a sustained move here. We have a massive weekly head and shoulders. This chart you see right in front of you is a weekly chart. So this goes, not a weekly, but a back to the September of 2009. It's just a very compressed daily chart. A weekly chart would look very much like this. Now, this gigantic formation here took months to complete, this little thing I have circled right here. Now, this other one, I'm going to show you right here, this big head and shoulders area. This took years to complete. And we've already broken through the neckline, the first neckline right there, which means it's very bearish for me. Now, breaking through the second little neckline that we did here with the 126.86 target, now that puts us right above that other lower trend line there. So we could see a months and years long move here in the euro US dollar. I do think it could happen, and the target ranges for this are 110 to parity, 1.000. So these are really big formations. We're going to be watching these carefully. Right now we're looking at 126.86 in the euro US dollar. So last week I talked about the euro and the pound, and we had a short cover rally, could cause a euro to US dollar rally. What it turned out, there was actually a little bit of a divergence there, but really what happened, the short cover rally it kind of fizzled out there, and so when that short cover rally went away, the euro US dollar broke the neckline. Now, I want to be very clear. We're going to watch a lot for the divergence between the euro and the pound, and I'm going to show you a little bit about this in the charts, but as I talk about the charts, I'm going to talk about what's happening in the fundamentals as well. Now, here's that same head and shoulder style formation that we saw in the euro, but as you can see, the pound broke out higher. So it also kept breaking higher, but this short cover rally definitely then just fizzled out. And what did we see? All this stuff kind of went away, and we saw this go down right here. Now, I want you to watch for a divergence between the pound and the euro, and here is why. Because the pound has still been committed to austerity by both the UK central bank, the Bank of England, and the government over there. They're still talking about austerity over there when the entire European continent besides them is seeing like a wave of kind of spending-friendly, write-down-friendly governments sweep into power, especially in the states that are most likely to write down their debts. So these things right here, points out there might be a divergence between what happens in the euro as people write down their debts and spend a little bit more, making a weaker euro, and what happens in the pound where there's more austerity on the way and the Bank of England's trying to keep a handle on inflation. So these two things right here, I'm watching for a divergence in these two. And so, you know what, let's move on to the Australian dollar right now. The Australian dollar has been dominated by the carry trade for such a long time. It's been the biggest news in the actual Australian dollar over the last couple of years. Now, just to review real quick, what is a carry trade? You buy a currency with the high interest rates, and you get to lend it out then, and you sell a currency with the low interest rates, and you get to borrow that one. So This is how it works for Australia. You buy the Australian dollar, you get 4.25% or so. Maybe it's 3.75 right now. So you're getting a high interest rate. And what you do is you sell the US dollar and the Japanese yen and you pay a very low interest rate, around 0.25%. So that's a big spread right now. But what we're starting to see here is something pretty interesting. This carry trade is breaking down. Now this breakdown has been one of the biggest risks of the last 2 years. We've seen it break down a couple times. Back in May of 2010, we saw it break down. The Australian dollar lost nearly 14% against the US dollar. During that time, the Australian dollar lost nearly 14% in just a few weeks as this carry trade broke down. So this breakdown of this carry trade has been one of the biggest risks over the last 2 years, and I've written so many words about this since the late 2009. So what does that mean if the carry trade breaks down? What does that actually mean? Well, carry trade breakdown means something very interesting. You want to sell the Australian dollar and you buy Japanese yen and US dollar. And we can see the beginning of that happening in the Japanese yen and in the US dollar. If this trade breaks down, we could see a nice rally in both of these currencies. Let me show you something interesting though about the Japanese yen. A few weeks ago, I had this chart up here, and this is about possibly breaking through a trend line. It turns out that leaning long was wrong. I was very wrong. Since then, the Japanese yen has gone down. This trend line has held pretty well. I have some skepticism about that, and let me show you a little bit more about that right here. So in this chart, you can see this is the last couple weeks in the Japanese yen here, and you can see that there's some support over here, support there, and we broke through that support. Now, I don't want anyone to forget about what happened with Japan and China back in February and March. Now, back in February, you can see the Japanese yen just took off. It absolutely took off, went down dramatically. Now, that upwards movement on the chart there means the Japanese yen is getting weaker. Now, if you recall, that's because the Japanese central bank, they said they now have a 1% inflation target. That is a big change. It is a big deal. Do not forget about that. Always remember that going forward. This Japan and Japan's central bank is now committed to at least 1% inflation, whereas before the expected inflation was 0%. So back at the very highs of this chart here, you look at the very, very highest day of the chart. That is the day that China and Japan announced a deal for Japan to buy some of China's government debt. So I think this range right in here is something that's going to be supported by both Japan and China as being a proper value for the Japanese yen. Now, I know this is kind of a complex thread to follow, but even though we're breaking support right here, because of what's going on with Japan and China, I think it smells like a range to me. I mean, are we going to break some of these levels? Yes. Are we going to break some on the upside? Yes. But I really think it's going to be a range right here, basically jointly managed by China and Japan. They'll say, you know, we're going to keep it right in this range right here. We don't want the yen to get too much stronger. We don't want the yen to get too much weaker. We like it just where it is. Now, if you think back to that carry trade that we were talking about a little bit ago, just think about that. You know, how does this all work together here? Even with the carry trade breakdown, you can see it happening right in through this area right here. Now that's the Japanese yen getting stronger. Remember what I said when the carry trade for the Australian dollar breaks down? Sell Australian dollar, buy Japanese yen. That's what's happening right here. Now I think this has kind of reached the limit of where Japan is comfortable with the strength of the yen. So what is that going to mean going forward? Well, pretty interesting. We still need to sell Japanese yen and buy US dollar, but that buying of the Japanese yen, that's not going to happen as much anymore. So the Australian dollar is going to need to get sold against the US dollar. Now, for a long time, Australia has been the lucky country. They've pretty much avoided the worst part of the financial crisis. They were able to do a lot of things that other countries weren't really able to do because they had a great housing bubble. However, something horrible has happened in the last year. Their housing market is starting to crumble dramatically. Now, given what we know about what happens when housing bubbles break, we know that central banks cut rates aggressively when they see these housing bubbles start to go. That's what we did in the United States. That's what they did over in Europe. When these housing bubbles, housing prices start to go down, central banks panic and they cut rates. What does that mean? That means a lower interest rate over in Australia, and this carry trade is going away. Now, it's not just that. When the RBA cut the rates by 0.5% at one time, that's a shocking move for them because they've been inflation hawks for so long. The Central Bank of Australia has been very, very hawkish on inflation. They've been worried about inflation out of China for a long, long time. But still, they've had low inflation. Even though they've been worried about inflation, they've had low inflation. Even though they've been worried about high inflation, they've actually had low inflation. Even though they've been worried about high inflation, their inflation has actually been contained. This low inflation gives them a green light to cut rates even more going forward. And not only that, we're seeing this oil dropping recently. It might be a canary in a coal mine for the commodity markets. I spoke about how the commodity bubble might be bursting. Oil dropping 7% in just a couple of days, that's a big deal. Now, we've seen for a long time, over the last several months here, probably the last 6 months or so, that the commodity demand out of China is slowing. Now, additionally, we've also heard stories about massive stockpiles of copper over in China, and copper being used to fuel their real estate bubble over there. We think all that's going away. I think all that's going to go away, and it's going to put a lot of pressure here on Australian dollar. So, because China has reduced their commodity usage, the central bank, the Reserve Bank of Australia, has lowered their economic forecast. Now, what does low inflation and bad economic forecast means? That means that these guys are going to cut rates aggressively in the next few months. We're going to see a big drop in the Australian dollar, and it's going to happen soon. So, if you recall from last week here, I talked a little bit about this right here, and I thought, oh, you know what? This carry trade is going to reignite and go up. Well, guess what? It's not going up. What we did, we flipped our position as soon as we realized this was going to happen, and we've got short around that level right there. We think this is just the beginning of a downward move rather than the end of a downward move. If oil can break below 95 a barrel, break below 90 a barrel, if copper can go down a little bit more, we could see absolute carnage in the Australia US dollar. Remember, all the selling pressure will be focused on the Australia US dollar currency pair and not in the Australian dollar Japanese yen, because China and Japan want the yen to stay about where it is relative to the US dollar. That means the carnage will happen in the Australian dollar US dollar. Very important, hugely important point. So let's move on to the Canadian dollar, which is another commodity currency. We know it's choppy. I showed you last week. I'm going to show you again this week. This is a choppy currency, and it's very related to oil prices. Here's the dilemma that makes it choppy and why oil prices are such a big deal. High oil prices are bad for the U.S. economy, but high oil prices are good for the Canadian economy. Due to the amount of exports that Canada has to the U.S., other than the price of oil, there is this ongoing dilemma. Are oil prices going to boost the Canadian economy, or are higher oil prices going to be so high that it destroys the U.S. economy and drags down demand for Canadian oil? Which one will it be? You can't really tell. It's hard to tell at any given moment, and so people speculate wildly on this currency pair back and forth. We've seen tons of back and forth movement in this. Now, if you remember from last week, I talked about this some more. Last week, what happened? Oil tanked. So that choppiness was right there. When oil tanks, CAD tanks. Here's a chart of not the US Canadian dollar, but rather of oil. I pointed out this gigantic formation here of choppiness, but what happened just in the last couple of days of last week was something, it just tanked oil. So you see this oil right here. That's the same line I drew for you last week. So far oil has dropped to that level. And that's just a huge drop in the price of oil, almost a full 10%. It's actually 8% at current prices in just a matter of a few days. I've seen gasoline prices are dropping equally as fast. We could see a complete carnage in the Canadian dollar as a result. So I drew this last week and I said, hey, watch out for this back and forth movement. I don't care if this is going one way or the other, but we know that there's going to be a lot of back and forth movement. And then I drew this nice little thing like here, like, oh, you know what, this is what might happen going forward. Lo and behold, even though it's choppy and the oil prices dominate, it's going forward. What happened was exactly that. So our oil price is going to turn, or is the Canadian dollar going to turn around and go the other way? It's hard to tell. We tried to buy an extreme a couple weeks ago. It didn't quite work out. We got stopped out, and then all of a sudden, a few days later, it slips back the other way. This is to be expected in the this kind of market that we're in right now with the Canadian dollar. We try to get on when we can for a good price, but we want to keep our risk very, very tight to prevent any blowout style moves. So are we going to try to sell the Canadian dollar right here or the USCAD and buy the Canadian dollar? No, I think oil prices are going to go down a little bit more. We're going to wait to an attractive level, kind of closer to the top of that range here we see before I try to initiate a short position. And if you go back down lower down there, I'm definitely going to try to initiate a long position in the CAD. We're just trying to take a little bit out of the market here. We're not trying to be too aggressive with this market. We're trying to take advantage of the choppiness rather than have it work against us. Our last trade, I think we lost 15 pips or something like that. That's what we're going to do. Take a little bit amount of risk and try to hit singles out of this thing. Take a small amount of risk and hit singles. So for the CAD, just a reminder, we had this huge move last year from September all the way to May of 2011. But you can see this thing was just awful in terms of choppiness. It was a big move in terms of overall price movement, but the choppiness was just astounding. To trade this thing and make money actually selling it, even though it went down a lot, would have been very difficult. That's something we always have to watch for in the CAD, and we're going to watch for in the future. It's a choppy market. Please be careful as you trade the CAD and use that to your advantage. Use the choppiness to your advantage. Buy extremes, sell extremes, and try to catch just little bitty trades out of this thing and make some money in the CAD. So remember, oil prices dominate. What happens in oil is going to have a big impact on the Canadian dollar. Also, as oil prices go lower, let's say they go below 90, oil prices and the CAD even become more strongly linked. So it will be still choppy, but the link between Canadian dollar and the oil prices get stronger when the oil prices are between $70 and $90 a barrel. If that happens, expect a very strong link between the US Canadian dollar and oil prices. So trading. This is something that I spoke about last week, and I'm going to say it probably almost every week. Trading is about strong opinions being weakly held. You have a strong opinion about something, but then when the facts change, you should change your mind. Act decisively and change your mind when the facts change. Always have a couple of scenarios running. Always go with the one scenario that seems to be most dominant at the time, but then if the facts change and another scenario becomes dominant, go with that scenario. There can be some gigantic trades by doing this type of thinking. Have a strong opinion about what's going to happen, throw it out as soon as it's not working anymore. That's how you trade well. So this is Mike. Thanks for listening to this video here. Let's see if I can get it over here. This is Generate FX Outlook for the week of 5/7/2012, the week of May 7th, 2012. Thanks and trade well.